This is what we want our endgame portfolio to look like. It's a cash-flowing, money-pumping machine that prioritizes passive income generation. It's a beautiful mixture of assets with high yields and assets that defend and maintain wealth.
What it is not primed to do is grow. This is your endgame portfolio. It's what you want your portfolio to eventually look like once it's as big as it needs to be to pay for your lifestyle. The portfolio that you build and nurture over the years will look very different to the endgame portfolio.
While high growth stocks matter a lot to you when you're building your wealth, once you reach the endgame, you'll be shopping around for physical gold bars. And while the bulk of your portfolio should be in ETFs during the growth stage, by the time you're ready to retire, they might not even make up half.
In today's video, we're looking at how your portfolio should evolve over the years to move from one of killer growth to killer cash flow. Let's check it out. Welcome to moneyunshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
Those looking to fill the growth stock section of their portfolio with ass-kicking American tech companies might consider our sponsor, Stake. For our new viewers, Stake is an FCA-regulated free trading platform for buying US shares.
On the Stake app, there are 3,500 US stocks and ETFs. You won't get that level of choice on any other free trading app. And you get unlimited commission-free fractional trading in real time and FSCS protection.
Our sign-up link on the offers page on moneyunshackled.com nets you a free US stock worth up to $100, linked in the description below. Now let's get into the video.
This is not glide path. Those who know how a pension works know that they reduce their risk profile over time as you reach your retirement date. The fund managers will gradually sell out of riskier, fast-growing stocks and replace them with boring, dependable bonds instead. This is called the glide path strategy. That's because you fall slowly out of the sky until you hit the floor, or you devour your portfolio until the money is gone, which hopefully won't be until after you're dead.
This is not what we're doing here. We are not significantly de-risking our portfolio by moving away from stocks and into bonds as we approach retirement. That's just running away from a manageable risk by relying on mediocre assets. Rather, we will enter the endgame by changing the focus on our favourite asset classes, from growth and attack to cash flow and defence.
We're certainly not completely de-risking in the classical sense. We'll even be adding in so-called riskier asset classes as our wealth grows.
The Derisking Fallacy, bonds. De-risking a portfolio doesn't always work. By moving a portfolio into low-risk bonds like pensions do, what you're saying is, I can eat into my pot for X number of years until I die. This setup can work for those wanting to retire at 70, but we can be smarter than that. And what happens if you live longer?
Let's look at bonds in our endgame portfolio. Bonds make up just 5% because they suck for yields, especially in today's environment. But they are good to have as they often go up in value during a stock market crash because you can sell them and cash in.
Smart protection. Instead, we'd want to protect our wealth by other means. 1. Diversification across many asset classes. 2. Physical holdings. 3. Focus on income regardless of market price movements.
But before we get there, every end starts with a beginning. If you're already as rich as you need to be, you can skip ahead to the components of the endgame portfolio. But if you're still building your wealth, you're going to want to start with something like the year zero portfolio.
The year zero portfolio. When you're starting out investing, you want your wealth to grow fast, and you're in a fortunate position that you can stomach some risk. You don't have time for bonds, and this portfolio has none of them. Cash is wasted sat in your bank account, so it's kept to a minimum. Returns on high interest assets like peer-to-peer lending beat inflation, so are welcome in small doses to diversify the asset mix, but all returns are reinvested and left to accumulate.
Commodities include gold, oil, wheat, orange juice, copper, things which are the same the world over, which should rise by or beat inflation. The defensive portion of this portfolio is therefore 25% of our net worth.
The rest is all attack. 75% of the year zero portfolio is made up of equities, but we're not taking unnecessary risks. 60% of the portfolio is well diversified global ETFs, and here we'd be buying our favoured mix of exchange traded funds that invest in thousands of companies across all major world economies.
We're hedging our bets by having some of the ETFs be high yield. Another description for these could be low growth. These are made up of big blue chip companies that pay high dividends. But their growth days belong in the past because they are already supergiants.
And off the equities, we only allow 15% for stock picking. This is where we would really look to add value and attempt to beat the market by investing in companies that we think are poised to do well, while recognising that this is potentially a high risk section of the portfolio.
But it's also the most fun section, and where you get to have a play around investing in companies you think will add value to your portfolio, like the thousands of US companies available on the Stake app and others like it.
When can you become a property mogul? There's no property in the year zero portfolio because you probably can't afford to buy any when you're starting out. Any investor worth their salt will see the value in owning some rental property, in part because it diversifies your asset classes, giving you income from different sources, and it can give the highest consistent returns because you can leverage your investments using mortgages.
We will include rental property in our Endgame portfolio. Target retirement pot. After enough time has gone by and you're approaching your target retirement pot, we can start selling some of our year zero portfolio growth assets and start buying our Endgame portfolio cash flowing assets. You can start the transfer in the years running up. There's nothing to stop you from buying some rental property as soon as you feel you can afford to.
Our initial target investment pot is 500 grand because that gives us a £20,000 per year baseline income to cover basic bills if we withdraw 4% from the pot each year. We should be able to withdraw 4% without damaging our pot size and still allow for inflation of a further 3% because we will still be making decent 7 to 8% returns from our diversified mix of endgame assets, rather than settling for between 0% and 3% returns on bonds like we would under the glide path strategy.
Endgame portfolio. Here is our hypothetical endgame portfolio. We've moved away from balanced ETFs and vastly increased our high yield ETFs as we are now predominantly about income. Rather than growth stocks like technology startups, we opt for dividend stocks like energy, utility and healthcare companies.
And there's a big section for rental property. For 100 grand, this might represent 3 rental properties bought using mortgages, which by themselves could bring in £1,000 a month profit. Some people love the high yield cash flow nature of rental property and would choose to have a higher weighting than this in their endgame portfolio. We've gone more for liquidity and passivity here, accepting the lower returns of the other asset classes in return for an easier life.
Regular viewers will know that I hold most of my portfolio in rental property because that is my background and where I started out. When I come to the point of finalising my endgame portfolio, I will likely sell off a chunk of it and spread it across the other asset classes, or accept a higher risk and lower diversification in exchange for the higher returns.
The traditionally defensive section of this portfolio adds up to 35%. Cash is high at 10%, a cool 50 grand sat there doing nothing, other than meaning that we never need to worry about money anytime soon. Bonds are there now. These are held as historically they tend to move in the opposite direction of stocks and so provide some hedging against stock market crashes. They also have the upside potential that we could cash in for a decent gain if central banks start pumping more money into the economy as they've been doing recently.
High interest peer-to-peer loans are still there, but now we draw an income from the interest rather than allowing it to accumulate. And because we're finally filthy rich, we'll be buying gold in great quantities to protect our wealth. Much of it will be through gold ETFs, but we'll be stockpiling some physical gold too and stashing it under the floorboards. Ain't nobody getting their hands on that if there's a market crash.
Question of the day: what stage of portfolio building are you at and what are you buying right now? Let us know in the comment section. Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.